The host for today is Sandeep. I would like to introduce Sandeep. Sandeep is a co-founder at Multipie. He has 20 years of experience in fixed income, including heading credit business at Bank of America from 2008 to 2010. In 2011, he founded a lending NBFC called Indus Capital, which went public in 2018. Over this period, Sandeep has done credit deals of rupees 50,000 crores in which there was nil loss. Also, I would like to introduce our guest speaker for today, Amit Goenka. Amit Goenka is MD and CEO of Nisus Finance, which manages two AIF real estate funds with an AUM of rupees 8 billion. Under his leadership, Nisus Finance has established itself as a premier investment manager with 100% exits and superior returns in time. Over the last 21 years, Amit has created a niche for himself as a leading expert on India real estate, infrastructure, and financial services covering all asset classes pan-India. Prior to this, he was the founder, MD, and CEO of Z Group, managing AIF real estate funds, PMS, and offshore funds. At Knight Frank India, Amit led the capital transactions, investments, and other verticals, which managed nearly $700 million of transactions across land, residential, office, and hotels. Amit has in the past also worked with EY, Aditya Birla Group, and BE Investments. Amit holds a bachelorate degree in engineering and has also done MBA. Now I would request Sandeep to take over.
Thank you, Pankti, for the introductions. I'm just trying to get my screen in proper place.
Yeah, Sandeep, we can see the screen.
Okay, great. So thank you everyone for joining in. The format for today is a 7 to 8 minute presentation by me on an overview of fixed income. Then we'll take a few questions on fixed income. This is generically fixed income. After that, hand over the stage to my dear friend Amit for him to tell us about Dalmia Nisus as well as the specific product, and then we will take questions on the specific product. So let's start, guys. You know, in the long run, as we have often discussed, it's equity that gives the longest returns. Nevertheless, fixed income forms a part of the portfolio for reasons of liquidity, diversification, and returns. As we know that when interest rates rise, there is a diminution in value of long-term debt instruments. There is an inverse correlation between interest rates and the value of bonds. Currently, we feel that interest rates are poised to rise, and therefore we have a negative view on very long-term debt instruments. Our reasons for feeling that interest rates will rise are primarily the globally high inflation that is prevalent currently, as well as the commodity price pressure that we in India are feeling. Over time, this will definitely force RBI to increase interest rates. You know, there's a whole plethora of fixed income securities options available to investors. Today, we will discuss some of them as a brief overview. But remember, to evaluate the credit risk, there is no such thing as a free lunch. Let's look at a very simple fixed income option, which is mutual funds. Safe from a credit perspective, but unfortunately returns are very low, 3.5% to 5%. And there is also the risk of capital losses on long duration debt funds. Next, there are some more fixed income options without credit risk. These are put up on the screen. We'll just talk about the two ones that we like. One is savings account in well-managed scheduled commercial banks, which give 5 to 6%, and provident fund, which gives you 7% and is also having a lot of tax advantages. Then there are some fixed income options that carry a credit risk. Cooperative banks, they give you 6 to 10%, but we don't like them because we feel They're not systematically important. RBI is not behind them, and the risk is too high. FDs with corporates and NBFCs can give you between 6 and 10%. Here, our view depends on the issuer. For example, we like Bajaj Finance, but we do not like MFIs, as the loan book of MFIs is unsecured. And then there is real estate bonds that can give you between 10 and 20%, depending on the issuer and the structure. Here again, we don't like every transaction. It is very transaction specific. I just also want to take a minute to cover how Multipie can help you guys on fixed income as well. You guys have known maybe Multipie a little bit more for our equity things. You can post any question, not just on equities, but also on fixed income, and we will answer it on the platform. Let's take one example. This is a question from Yashika. My existing savings bank account with a PSU bank is giving me 3%. A cooperative bank has approached me with 8.5%. What should I do? And our answer has been, Yashika, you can certainly move to higher paying savings account of well-managed scheduled commercial banks like AU, Indus, and Equitas, because since independence, depositors have never lost money in scheduled commercial banks. However, cooperative banks can be risky as they are not important systematically. Case in point being PMC Bank, so you can avoid cooperative banks. At this point, I want to take a few questions on fixed income in general, if there are some. Please keep your questions to fixed income in general at this point in time. Happy to take 2-3 questions, after which we will hand it over to our guest speaker, Amit, to tell us more about himself, Dalmia Nisus, and the product opportunity. So I'll just pause here if there are any questions. Guys, if you can put the questions in the chat box, it will be better. I can see that 2 participants have raised their hand, but operationally, it's just easier for us. If you can type in the question, we will acknowledge your name and read out the question. Okay, there's a question from Vaibhav Arora. View on covered bonds products like Wind Wealth. I'm presuming this means products available on Wind Wealth. So recently, RBI has come up with some notifications that make covered bonds unviable from a regulatory perspective. And therefore, you will see that even Wind Wealth has now changed its product offering a bit. Its latest products will be regular bonds and not covered bonds. And the view on each bond will be very product specific. We may like X bond, which is offered. We may not like Y bond that is offered. It is entirely a function of the credit quality of the issuer. So that's things. The next question is a question from Neeraj. Why do some banks like AU and Indus offer higher interest rates? A great one. So Neeraj, not all banks have the same distribution network or a franchise as SBI, ICICI, or even say Axis or HDFC. So they need to offer that additional interest rate to their depositors so that they are motivated to bank with them. Now, we don't like all of these banks. So for example, we may not be fans of Ratnakar Bank, but we definitely like AU and IndusInd because we think they are well managed. The stock market also values AU very highly if you want to take an independent barometer. Very importantly, all of these banks are scheduled commercial banks, as we discussed earlier in the presentation. And since independence, no depositor has ever lost money in a scheduled commercial bank, because there's a systemic risk if depositors lose money in scheduled commercial banks. So we like scheduled commercial banks, but we do not like cooperative banks. Do keep that distinction clear. There is a question from somebody who wishes to not share his name, which is Bharat Pay 12% fixed income. So I will admit that I have not studied Bharat Pay adequately to answer this question. But in general, I would advise you to look at the profitability of the company very closely. We are not fans of companies that are perpetually loss-making or expected to be loss-making for the next 3 to 5 years, because as a fixed income investor, you are investing for that additional 4-5% return, obviously, but you want safety of capital to be also paramount. The next question is from Anand Agarwal. Should we avoid the cooperative banks completely or case-by-case basis? Is there a way to identify more secure cooperative banks? Anand, my view would be to avoid them completely, because for fixed income, we do keep safety first. It is very, very difficult to do a very detailed due diligence on cooperative banks because their books tend to be more opaque. Unless you have complete loan by loan information on the asset side of a cooperative bank, you cannot really go on a limb and say that this bank is safe. And it's very difficult to get that kind of information because they are not listed as well. So I would actually say simply avoid cooperative banks. Remember, if something goes wrong, RBI will not there be to protect your bank. They are not systematically important. You are so much better off going for a scheduled commercial bank. You might get 1% lower return or 1.5% lower return in an AU. But look at it this way, it's listed, right? There is independent reports available on it. They have to share their information on a quarterly basis. And most important, RBI is behind them. I would not go for that 1.5% additional in cooperative banks. The next question is from Umesh Marigiri. How is commercial scheduled bank different from other banks? So they enjoy, broadly banks are of two kinds, scheduled commercial banks and cooperative banks. Within scheduled commercial banks, you can have subcategories like PSU, private sector banks, small finance banks, doesn't matter. All scheduled commercial banks enjoy the safety and the support of the RBI. They are managed and governed by RBI. It is, they are systematically important. RBI will stand behind them. At least so far it has stood every time in the last 60 years. Even in fraud cases like Yes Bank and Global Trust Bank, depositors did not lose money. The other basket is cooperative banks, which I just covered and we do not like. The next question is from Uday Shah. For needs beyond few years from now, say 5 years from now, is it not good to invest in corporate bond fund or banking and PSU fund, as they will align the yield with change in interest rates? So you, Uday, you have to look at the duration of the corporate bond fund or banking and PSU fund. If that is a 2-3 year fund, you can look at it because it's not very long duration. But if you are going for a 5-year fund, you could say that, look, I need money 5 years later. I've taken a 5-year duration fund. It matches out. Yes, you could take that call, but do remember that in the interim, you are exposed to a lot of loss of value in terms of capital losses because interest rates are expected to rise. I would actually advocate you to possibly look at some kind of other bonds, including, by the way, a savings account with banks like AU, which can give you 6 to 7% in a fairly safe manner. A 5-year duration bond fund will give you about 5.5%, right? Which is nothing great. And further, you are exposed to the risk of interest rates going up and therefore the value of your investments going down. So not a fan of long duration bond funds purely because my view on interest rates right now is that they will go up. Tomorrow, 2 years later, 3 years later, if GSEC crosses 8%, then my view will reverse and we will say that, look, you can go into long duration bond funds because we expect interest rates to rise and therefore you make capital gains. I think I have taken all the questions at this point in time. Just let me check. Yes, I have taken all the questions. Thank you so much to each of you gentlemen who have asked these questions. It's only these questions that make the session more interactive, more fun. And at this point, I can see that Umesh Marigiri has raised his hand. Umesh, if you can type in your question, it's just operationally so much easier for us. I will wait for a second for you to type in your question, and then we will, hand it over to Amit.
I think in the interim, there may be some Q&As as well, Sandeep, if you wish to take.
Sure.
Apart from the chat, I see some questions.
Is there any? Okay, is there anything in the Q&A? I was taking the questions from the Q&A, Amit.
Okay. So some in the chat. Sorry.
Chat, okay. Okay, all right. Though there are more questions in the chat. Sorry. Okay, let me take them. Harshit, what's your outlook for fixed income as a part of portfolio? Do you see it as a hedge or more than that? You know, we always look upon a portfolio as a diversified basket of assets, the primary being equity and fixed income. It's a little bit more than a hedge because it provides you liquidity and it provides you a steady return so that in a falling equity market, you are not getting nervous. And if the market were to fall, you have the firepower to double down on the equity market. Not everybody has the mental makeup for being 90, 100% invested in equity markets over very long durations. I know it's easy to think so in the middle of a bull market, but after having seen people investing for 25 years, I do know that it's only 10% of the people who can say that I will be 100% equity 100% of the time. For a lot of us, including me, it makes sense to have some fixed income for peace of mind. It's not just hedge, it's also peace of mind. The next question is from Nishad. What's your view on fixed income product offered by Cube Wealth? They sublend monies to company like Furlenco and promise 12% return. See, I don't want to make a very sweeping statement on all products on Cube Wealth. I only then want to cover the specific company that you have mentioned, Furlenco. So Furlenco 12% is way low because I know that Furlenco product is available in the market for 20-21%. And one thing that I would direct your attention to on Furlenco, I do know that one of the platforms says about Furlenco that they have raised 1,000 crores from Xenia Capital. We did some diligence on that and found that the actual money that Xenia Capital has put in is only 20 crores. The balance 980 crores was cancelled. So Furlenco, you need to be a bit careful because while they got capital commitments, they were from unknown funds and they got cancelled. If somebody is telling you Furlenco, ask them how much recently capital they have raised. If they tell you they have raised 1,000 crores and all, ask them how much of it is in the bank. Out of that 1,000 crores, only 20 crores is in the bank, which to me makes it not a great investment because they are not adequately capitalized. There's a question from Abhinav Mangi on Bharat Pay, and I will admit that I have not studied Bharat Pay adequately, so I will request you to look at the financials and take a call. As I have said, we prefer companies that are profit making or likely to make profit in the next couple of years. Okay, Uday's question I've already taken in the Q&A. The other questions are in the Q&A. Okay, there's a question from Nilesh Kanawade. What's your view on post office deposits? We think they are safe because they are backed by the government. The next question is from Naman Jain. What about REIT funds like IndiGrid paying dividend at 3 rupees per quarter? So guys, I think they are pretty good products. IndiGrid is a very safe product because you are getting your money from Power Grid, which is AAA. Just be aware that besides the yield, these products are also subject to being listed capital gains and losses on the stock market. So the return may not be as steady as you want because you have mark to market on the stock market. But yes, they are safe products, but they're somewhere lie between debt and equity because while the yield portion is pretty much fixed, the capital trading portion fluctuates on the stock market. It's not like a bond, which is steady value. But overall, they can be a part of portfolio, absolutely. What's your view on retail participation in government securities moved by RBI? This is a question by Neeraj. So Neeraj, RBI has wanted to always increase liquidity in government securities for the last 20 years. That's why they did this move. For you as a retail investor, frankly, just remember one thing, you always have the option to invest in government securities because you could buy into GSEC funds that are offered by mutual funds. It's not a very new investment option that has opened up for you. And actually, if your amounts are low, then I actually believe that investment in GSEC funds of mutual funds is a better alternative to going and buying bonds directly on the market because your impact cost of purchase and sale will not be there. You can easily get in, get out with small amounts. These funds will give you daily liquidity. And lastly, if in case you were to hold the instrument for more than 3 years, mutual funds are tax efficient unlike directly buying the GSEC. Having said that, if you want to try it out, you can try it out. It's a safe product. It's definitely safe. You want to try it out for once, sure, go ahead. There's no big negative as well. It's just that mutual funds are probably more convenient, the GSEC mutual funds. The next question is from Kunal. Is it advisable to look at REIT funds like Brookfield, which is giving 7% return? So guys, here again, the yield portion is pretty much fixed. But remember that the capital value will fluctuate in the case of REITs with commercial property prices and rentals in the country. So if you look at Brookfield, it listed at around 270, it went 280, it went all the way down to 220. Today it is trading at premium to IPO. So, just remember it's a product between debt and equity. It can be a part of portfolio, but do not expect the capital value to be constant because to that extent it will behave like equity. Okay, Saurabh has made a request. Can we move to the main agenda of 16% fixed income product? Saurabh, certainly we will. And but I do want to just take a minute for the balance questions. Vibhor, do you think REITs invest will be affected in interest rate hikes? Obviously, they are very long duration products. If interest rates increase, then definitely there will be a diminution in value and they are affected by that risk. What about integrated funds? Again, as I've covered it, my answer is the same. Neeraj wants to start with the main program. Amit, there's a lot of demand for you, so let's do that. And I will hand it over to Amit at this point in time. Amit, obviously a very distinguished professional, as Pankti introduced at the start, also a close friend. He will talk about himself, also about this specific product, which of course he has analyzed and we have also analyzed, and I'll cover maybe in 1 or 2 minutes about how we have analyzed it somewhere later. But at this point, on public demand, over to you, Amit.
Thank you so much, Sandeep. It's what a pleasure to be here with you on this platform. Not only are you a good friend, but I think you're also a great educator. I was actually enjoying learning so many new things from you and from these questions, and I was hoping I didn't have to jump in. But again, thank you again for hosting me, and it's always a pleasure to talk about a subject and a product that I love so much. I've been at it for the last 14 years, and it's made great wealth, great returns for me, which is why I'm personally, almost 100% invested in this product myself, and I propagate it with a passion, not just domestically, but also internationally. It's an investment asset class which has found flavor with the who's who of investment in the world, whether it's mutual funds to start with, or NBFCs, global institutional funds, including fund houses and sovereign funds. So clearly, it's a great investment asset class, provided, as Sandeep rightly mentioned, you have to pick and choose the right product, find the right security cover, and find the right balance about what is it that you need to achieve as an outcome. For us, clearly, it is capital protection first, along with great returns. So the first mantra is capital protected enough? Can it come out in the right time? And do we have enough cover on it? And will it get better than market returns? I think those are the two, talking points for our product, which is very important. Otherwise, clearly in the sub 12, sub 10% range, there are enough and more things that have been covered by Sandeep very adequately in terms of the opportunity set. But what excites me about this is the fact is the security of the underlying. So hi, my name is Amit Goenka. I'm the managing director of Nisus Finance. Nisus Finance is a leading investment platform when it comes to alternative investments, especially real estate structured bonds. And the reason we do real estate structured bonds is because I think not only do we have a great understanding about the underlying, but we certainly believe that the value protection in the underlying assets, which being housing projects which are nearly completing, is of great immense value, which will not get destroyed over any short period of time. Cyclicality is significant amount of value in these projects and products, and which is why once the cover is maintained, the risk of capital becomes next to zero and the returns are more or less guaranteed. When I say more or less, of course, it's not a AAA product. It is not a government bond, and which is why one needs to be selective and careful about where one is investing and how the returns are being paid out. We have started a fund, which is one of the this is a fifth fund, and the fifth fund is a fund which is called Dalmia Nisus Finance. Dalmia Nisus Finance is a fund which is in partnership with the Dalmia Group. The Dalmia Group is a 75, 80-year-old group which is diversified interest. It's a North-based group which has got diversified interest, very well known for Dalmia Bharat Cement, one of the leading and well-valued cement players in the country, and has obviously been an investor and a sponsor to multiple very, very successful platforms and fund houses in the world, not just in India. And so therefore, they're one of the most blue-blooded pedigreed partners in the country, and we've partnered with them for this fund. Apart from their patronage and apart from the deep institutional expertise that Dalmia brings, Nisus Finance, of course, has a very, very well-heeled team covering almost about 180 man-years of experience in-house, which covers the entire gamut of asset management, right from underwriting to asset management to distribution to tax, legal, etc. So we are able to entirely maintain the quality and the delivery of our bonds on time for each of our investors, and which is why it's a pleasure for me to actually offer it through Multipie, because not only do I believe that it's an institutional play, but I also believe that it actually provides opportunity even for retail and family households to invest reasonable capital towards, so as to be able to get a good rate of return on their overall debt portfolio. So which is really why I think Multipie's partnership becomes such a valuable engagement, because it helps bring more understanding and better yields to our household incomes and our investment portfolios individually. With that, there is a specific product which has been also showcased, which is a recent transaction that we've done, and we can talk about that as well. Sandeep, if you can help me out, is it better for us to talk about the product, the construct of the fund, or get into the product now?
So maybe Amit, if you can cover in a minute how you guys approach real estate transaction, what are the things you look at, and then Pankti will do a shared screen of that PDF and we talk about the specific product.
Okay, wonderful. Most certainly. I'm gonna share a screen too in a minute, and this is really about the fund presentation that we have. Give me a second. Yeah. Okay. I'm gonna just share this in a minute. If you can see my screen, is my screen visible to all?
Yes, it is.
Okay, thank you so much for that confirmation. All right, so we obviously love, it's a very fundamental asset class, and especially mid-income and affordable housing and plotted developments effectively form the backbone of consumer demand and consumer aspirations and the population of our country. So we really go after asset classes or within projects, or we lend to, or we invest into bonds of companies and projects which are very, very, very secure, which are very well established and in the right micro markets. And really that is the objective, being what is in your slide is better returns at lower risk, right? So you can invest in a REIT, you can go and buy a house, you can rent a house, you can invest into any other asset class, but you don't have direct control. Here, what it means for us when you have direct control and direct investment is that you exactly get to control the returns of our investment, the underlying, liquidate, generate the liquidity required to ensure that the bonds are paid on time and exits happen with the requisite returns. Also gives you good diversification for a minimal amount of investment without having to put a large amount of capital to work, right? Why do we do it and how do we do it so well is because we invest a significant amount of our own wealth into each of our bonds. So, while statutorily we put in 15%, but almost 50% of every bond that we underwrite is invested personally by us as sponsors. So we carry a significant amount of from 15% to 50% of our own money is employed, which is clearly where our engagement in the investment is very high. And of course, we'll take questions very quickly, but let me take you through the product in general. It's very well structured in terms of securitization. We've had 14 years of investments and exits, and we have a significant team to manage it as well. If you look at how we filter it down, clearly the opportunity set for us is about 1,40,000 crores in terms of the quantum of bonds that can be issued and subscribed. We do only 500 to 600 crores of investments each year, which means out of our subset, we only do 0.42%, which means the, the best product, the best bond, the best cover, and the best cash flows that we see in the country. We only invest into that. We don't do very large amount of investments and for very large amount of capital. We do it for a very selective strata of the opportunity set. Yeah. If I have to come to the investment process, again, there's a significant amount of investment guidelines we follow to ensure that there is enough asset cover. Even on a distressed basis, one will get back, 1.5 to 2 times the money that we invested in the worst case scenario. Everything is escrowed, collateralized, mortgaged to us. So 100% control on the underlying bond assets through our teams. So effectively, we almost behave like we are in equity in terms of controlling the outcome of the underlying bond investment. There's a very deep investment process from evaluation to legal due diligence and just not legal, but legal, credit, financial, technical, corporate. So almost a 2.5, 3 months of intense due diligence, again with a round of deliberation with our IC, our investment committee, who will again go through all the issues, send us back, make us do more homework. So after a good 2.5, 3 months of intense exercise, whatever comes out of that funnel, get so not every deal will make monitoring. So it's not like we subscribe to the bond and we assume or hope that the coupons of the investment, the returns will come out on time. We ensure that it happens by active mandated monitoring on a weekly, monthly, and quarterly and annual basis, right? Very risk management that we're looking at market conditions, we're looking at economic conditions, we're looking at credit conditions, we're looking at liquidity conditions, and so on and so forth. So even during lockdown, even during the pandemic, 9 months of no activity in 2020, we had zero delinquencies, zero loss of returns, and zero credit write down. So I think that is again a testament to the kind of investments we've done, and I think this in a short talks about the kind of work we've done. If you talk about a portfolio, we've done, as I said, every fund has about 500 crores. Totally, we've done about 1150 crores in the last couple of years, generating anywhere between 16 to 18%. And of course, as I said, the organization has got a lot of in-house strengths to be able to manage these kind of credits. So, that's as far as our product and our structure goes. And I hope that is, gives you a flavor of the engagement that we have in this product. So it's not just a mutual fund underwriting process that we just go ahead and underwrite a certain credit and wait for the outcome to happen. It's a very active bond management exercise where we ensure that every asset is underwritten well, it's managed well, and exited on time, with the interest payouts either monthly or quarterly, whatever is under it, happening as per that schedule. So that's as far as our platform on this product is concerned, and that's how we manage our investments. And so whatever investments are being offered on Multipie, we will obviously be owning 90 to 95% of that. A very small sliver of that may come, or will be offered, on the retail platform or on individual investment platform, because all our investors, our fund is all institutional in nature. Even investors who are actually part of a fund are very large family offices or institutions who actually like this product and like a good fixed income return, and form it as a reasonable part of their overall treasury exposure. So that's how investors participate in these products with us generally.
So, Amit, thanks a lot for this overall process and about Nisus and Dalmia Nisus. Pankti, I will request you to put on screen the short PDF about this specific product. And while Pankti does it, I also want our viewers to know why we have liked this product as Multipie. So in any real estate transaction, you look at 2-3 overall things. First, who is the developer? In this case, it's a mid-sized group in Bangalore, but the development manager, Shriram Partners, is an extremely good one. Second is you look at the hard collateral cover and the overall cover. It's 2x. Plus you have pledge of shares, escrow, personal guarantees. It's a very strong collateral cover. Third is you look at the location, excellent location in Bangalore. So let's check some broad ticks. Then not only for this, for any real estate project, you look at the following risks. Approval risk, first thing, this project has all the approvals. Second thing is construction risk. This is a plotted development where very little construction needs to be done. So actually there is no construction risk. Very importantly, collection and developer risk, it's all being done by Shriram Properties, so money can't be pilfered. It all lands up in the escrow account which is charged to lenders. Finally, the biggest risk, sales risk, 70% of the project is already sold. So all of these gave us a lot of comfort. And last but not the least, the total transaction size was 30 crores, done by Dalmia Nisus as well as its LP partners. What is being offered on the platform is a very small amount of 2 crores. Maybe at some point we'll request Amit to increase it with 3 crores, but as of now it is 2 crores. And which means that there is a very dedicated fund manager with skin in the game, managing all the escrows, all the approvals for you. The transaction, by the way, is all already done. Dalmia Nisus has it on its books. So the transaction has not waited for anybody. It's a good transaction. It's done, consummated. What is offered now is a small secondary sliver. This is why we have liked the transaction. I will request Amit to speak for a couple of minutes on this specific transaction, and then we'll open up the house to questions.
Right. No, absolutely. Thank you, Sandeep, for that. And if you can just go to the slide as well. I mean, as Sandeep already covered that near the Bangalore airport, which is one of the most prime locations today in Bangalore, there's a plotted development called Shriram Rainforest, by the Shriram Group being the management and the development partner in the product. The other party being the landowner, which is also providing guarantees, land mortgage securities. Out of just hold on. Okay, these are the photos of the project. You can see that it's nearly completed. The works are done. The gateways are ready. The plots are ready. So really, hardly any work to be done in terms of the internal driveways are ready. In an overview of the plots, all completely done up. So really, no real work to be done on the site. We just basically need to collect the balance amount of money from the sold inventory, and we need to sell whatever else is left to be sold. So it's a very simplistic sort of thing. And why we believe that this will be easily done and achieved, because also Shriram has been in this business for too long, and they have a project in the vicinity, and not just them, others also have projects in the vicinity which have actually all outsold themselves. They're all fully sold out. So very little inventory left in this micro market for property development to be sold. So clearly, in our assessment, the investment may actually last for less than 12 months. So while we believe that it's an 18-month, while we've written it as a 24-month investment starting from November of last year, however, they are, this is something which I think will complete within less than 12 months from now. As far as the the location, as I said, is near Devanahalli Airport. So people who do know Bangalore will realize that it's close to the airport. A lot of work has happened within the Manyata Tech Park space. A lot of buyers are IT buyers, people who are in the northern Bangalore region, who love their own plot development, would like to make their own villas and stay. And this is therefore one of the most hottest asset classes as far as Bangalore is concerned. If you look at the security is obviously everything as part of the product. Is a security, whether it's past receivables, which is almost about 22, 23 crore rupees out of the 25 crore or 30 crore rupees, or 25, 22, 23 crore rupees is to be collected in the next 3 to 6 months from sold inventory, which leaves the balance money of only 5-6 crores to be collected from unsold, for which there is a significant underlying demand, which is being converted, the agreements registered and money being collected. So which is why I believe that the investment may actually not last for even 12 months, from the date of investment date. And of course, corporate guarantee, share pledges, Shriram undertaking, etc. So that's as far as this is concerned. And the cover is obviously 2 times the money, so which means there is almost 60 crore rupees, of residual value against the maximum loan of 30 crore rupees. So there's more than enough money to return our money quickly along with the return, and hence it carries a very limited risk. Okay, can go to the next slide. Yeah, I mean, this is in terms of, already 151 crore rupees have been spent in the project. The last 20 crores is to ensure that, the clubhouses are finished, internal beautifications are finished, and finally the developer exits this project. So there's very limited work effectively left in this project. Yeah, next. Right. So this shows the cover saying that there's enough money. There's enough money in the project for the repayment of loans, and this is a monthly paying coupon because there's a lot of money being collected every month. Almost about 5 crore rupees or more is being collected every month, and it's very easy to service the interest of this project. So hence, the monthly interest is being serviced in this product. And yeah, as Sandeep already covered, no approval risk, really no completion risk, and collection and sales for Shriram team is handling. So clearly no issues of the money not coming in time in the bank. It's a very fairly simplistic product as far as this deal is concerned.
Amit, there are a few questions on the
Yeah, yeah,
chat and the Q&A.
yeah. I saw a
For
plenty of
you, I will
questions.
just take one because that seems to be an underlying theme.
Right.
Is the investment proposition investing in Dalmia Nisus fund? The answer is no, because the Dalmia Nisus fund as an AIF, or the money is all fully raised. B, as an AIF, the minimum size that they can accept under SEBI rules is 1 crore. What they have accepted is actually higher from a lot of HNIs, but they cannot take by regulation less than 1 crore. What is on offer here is this specific transaction where this debenture will be sold to you in secondary. The minimum the face value of this debenture is 10 lakhs, and with a little bit of accrued coupon, I think the investment value will be a shade north of 10 lakhs. So you will get a specific exposure to this transaction only. You will not be a member of the fund. For the balance questions, I will request Amit if you can call out the name of the person who's answering the question and then take the question.
No, I mean, I think a lot of the questions are fairly generic, and I think we can answer them very simplistically. The first is, it's not as if Shriram Properties needs money at this cost. Please don't misunderstand that. The cost of borrowing of Shriram Properties by itself is very small. These are joint development projects, or joint venture projects or DM projects. Effectively, what that means is that Shriram Properties is taking its share of profits. The larger return being conceded or being offered by way of interest returns is actually being taken off from the profits of the landowner or the development partner as well, or the developer. So Shriram Properties does not effectively suffer any loss of interest because of this. Their cost of borrowing otherwise is much smaller. So effectively, when large developers like Shriram Properties, we invest in Purvanka, we invest in several other very, very large developers, these deals come to us when they're partnering with somebody where the partner may not have the same branding strength and credit profile, and therefore the partner ends up paying a lot more returns than what Shriram Properties does, and hence the bond in totality as a blended average tends to give a larger amount of return than what Shriram Properties by itself. If it was only them, as you realize, it's not just them, there's another partner there. So which is why they tend to have a better return. So it's just the way it is structured to make us better money. Otherwise, Shriram on its books will obviously never borrow more than 10.5%. So that maybe answers. And obviously, these partners and these development partners are all very highly rated agents, rated companies. So triple B plus, A minus, or A plus, double A. So these are the kind of partners who are partnering these projects to ensure that the monies are paid in time. And the returns, of course, the higher returns are conceded by their partners in the project.
I'll just add here that Amit has a very strong personal relationship with the Shriram Group for last 15 years plus. And that's also one reason why, Dalmia Nisus is today in the deal with all parties and having working and structuring this entire transaction. Relationships are also important.
Sure. I mean, absolutely right. I mean, these are not products that are available effectively. That's on retail. It's institutions where relationships are there, and therefore, the parties concede slightly better returns to us. As far as why the money was utilized, why the money is needed, is very simple because there was an existing debt by an institution which needed to be repaid. Every debt has a certain term. That debt was taken at the inception of the project. Maybe 4 years ago. It needed, or 3.5 years ago, it needed to be paid in about 3 years. Because of the COVID, they got a 6-month extension. But of course, each fund has its life. Because of COVID and other issues, the life of the project was extended by about a year and a half. And effectively, that's why this money was taken, so that the old lender could be paid off and the project completed over the next, or the project exited over the next 12 to 18 months. And that's the only purpose. It's a short-term need to effectively exit an existing lender and repay the money. Which is effectively that 12 to 18-month extension that most people got. Not all lenders offered that extension. So their lender did not offer that extension to this project, and hence, because of course it was also a private lender and it needed its money in a certain term. It was not a bank. If it was a bank, it would have got an extension. So it was a very simple reason for that purpose, that the money was required in this project. Otherwise, the project does not need money otherwise. Yeah. Yeah. So to answer that question as to why the money was raised and why they're not raising cheaper capital from a PSU bank, because again, PSU banks don't do refinance, by the way. PSU banks only come in when you get into a project at the early stage of the project. When you're starting up, refinance is not permitted by RBI regulations, by PSUs or other banks. So if it was an early stage project, which is what they typically do, they don't come to us for early stage projects. We also don't do early stage projects. We don't take early stage risk. We come into late stage projects which need completion capital, which need some bridge capital. There is some mismatch between the receipt of capital and the need for capital, and that's really where we come in. So we don't obviously take the underlying product risk. That's what banks do, and that's what the developers and other people do. Banks. We don't invest that capital. As far as the application, how to get those documents, Multipie will obviously host all of that on their site, and we'll get the application form, the presentation, and any other collateral and documents that you need with regards to this project to the Multipie team. Yeah, so I think that would largely answer the question.
Amit, I think there are a couple of more questions. I think because some of the questions are on the chat and some on the Q&A. Maybe
okay, so I'll take. I think largely on the chat we've covered. I'll look at the Q&A again and see if we've left out anything. I don't think we have. Sandeep, if you feel we've left out anything, let me know, because I think we've covered all of the questions largely on the product and on the hypothesis as well. So I think, guys, I think the general perception is that, if it's expensive, it's risky, people will get cheap money. If they're credible, that's not necessarily true. There are a lot of idiosyncrasies in the debt market, right? And the idiosyncrasies are related to the regulatory framework. RBI prohibits a bank refinance because if you need extension of time because of certain issues in the market, that is not permissible. If you need a top up on money because the cost of construction went up, that is not possible. So there are a lot of constraints when it comes to bank lending, and because of which people need to come to alternative investors and lenders like ourselves, or bond investors who will be willing to provide that time or refinance it a bit, provided that we're fully secure and covered. And we believe there is significant amount of value and risk mitigation in these investments. So I think that's one of the bigger reasons why a lot of people come to, not because they can't raise competitive capital. I think most of them are having a lot of competitive capital. So usually these bonds form a very small percentage of the overall debt profile of these developers or these projects, or these type of projects. So hence, as I mentioned, while the total opportunity is over 1,40,000 crores, there's still 500 crores gets invested. So you can imagine that where does the balance money come from? Of course, it is being put by banks and PSU and others. It's not something that we provide. We provide very, 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 very structured, very specific capital with significant collateral and with significant cash flows, and that's clearly why the opportunity set exists. Yeah.
Amit, who is the escrow bank for this transaction?
That'll be helpful. I mean, if you can maybe
who is the escrow bank for this transaction?
So we work exclusively with HDFC. So the structure is that HDFC is the escrow bank for the fund, for every transaction. Every project needs to have an HDFC bank account. If not, we shut all the bank accounts and ensure everything goes to HDFC bank accounts that we escrow and we control. And those SDFC accounts are directly linked with our drawdown accounts. So we can effectively sweep out all the money from the project accounts to repay the loans. So yes, yeah, HDFC Bank is a single bank for all.
Amit, I'll ask some quick fire questions.
Yes.
Do you remember who has done the valuation for this particular property transaction? I know you handled a lot of transactions, so I'm asking.
Yeah, no. So we've got Quantum who's done the valuation. Quantum is one of the largest technical consulting firms.
Okay. There's a question again from Kunal. How much has Dalmia Nisus invested in this?
It's a 25 crore transaction. So the fund has got an exposure of about 20 crores, 30 crores, of which 27 crores is invested. So the fund has an exposure of about 22 crores, and 5 crores is co-investors in the fund, which are largely LPs of the fund.
So which is basically your own investors. So it's
That's
not
right.
third party.
My own investor.
Yeah.
There is no third party or retail investor.
If Shriram is going to develop the project, why does landowner need this money?
So as I said, there's no need for the money for the landlord. Nobody needs the money. As I said, the money was utilized to repay an existing lender, which is where bulk of the money went. And a very small, so out of the 30 crores, 25 crores went to repay the landowner, the existing lender. 5 crores has been kept as a reserve to ensure that there is any, as a buffer capital, to cover any mismatches, any construction finance mismatches. Otherwise, there's no need for capital in the project.
Was the original borrowing for buying the land?
A very small, I mean, I think 50% was. 50% was put in by the developer, 50% was for buying the land.
Okay. Are these debentures rated?
No, they're not rated.
Okay. Yeah. So that was a question from Kunal. No, and neither do we encourage you to think of these as AAA, AA rated products. They offer a different return. They are a different structure of risk. Rating agencies find it difficult to rate these products because in the rating agency world, 1 day delay means default. That's the SEBI norm. In these products, I believe this one is a particularly safe one, but in real estate in general, it's common to see some delays, and therefore, even if it was rated, I can answer the question, the rating itself would not be very high, because for a rating agency, 1 day delay means D. For an investor who comes into this product, it's important to be able to take a little delay here and there, as long as you're getting your money back with interest. That's the outlook you should have. We are not recommending this product if you do not have that outlook. So like every product, it's not for everyone. Let me take a couple of more questions if I can spot it. On the risk reward matrix, where will you place this product? More risk than equity investment or lower? Clearly lower.
Lower.
This is not an equity investment. It's a high yield bond and definitely lower. Seems to be a product for ultra HNIs. Traditionally, this kind of product has been available only to ultra HNIs, but it's our endeavor at Multipie to offer this product in smaller lots. Unfortunately, the lot size available for this transaction is minimum 10 lakhs. But over time, we would want to get it down to 1 lakhs for certain products as well. The idea really is that products that are hitherto available only to ultra HNIs become available in more divisible lots to Multipie users. There's a question from Nishar, how can we apply? I mean, that is there on the Multipie website. We are happy to address it specifically also if there's a question. Is there any upper cap? Frankly, we want to keep it at 20 lakhs for this transaction because we want to have more users having the ability to participate in this so that over time people get more comfortable. Somebody asked a question on the management fee of the fund. That's not relevant because you're not investing in the fund. What has been the sale in the last month? Amit, you want to take that?
Yeah, sure. I think we've, as I said, there's very little inventory. What are the total plots that were available? If you can just scroll down, guys, on that screen. I mean, I don't remember what the total. Sorry, somewhere here. Yeah, 1 second. So yeah, we had 56. No, sorry.
56 crores of unsold inventory.
No, that's the value, and we've sold almost in value terms. We've sold almost in the last 2 months that we've invested. We've sold almost about 15 crore rupees worth of that, which is why we believe that the balance, so almost about 30, 35, 40 crores of inventory is now left, and that should also go in the next 3 to 4 months. Yeah.
Right. So since this IM was made in
If we invested,
3
it's
months
almost
ago, another 15 crores of inventory or 25% has been sold in 3 months.
So, yeah, in 2 months we sold 15 crores. We've collected about 10 crore rupees. So yeah.
Yeah.
In fact, there's
And
a
that's why the
significant amount of
product is
cash
also,
flow.
by the way, kept as monthly coupon bearing, right?
Yeah.
That's the confidence that every month the coupon will
Yeah.
be. There's a specific question from Jay Prakash. How far is this from Madiwala?
I don't know. I don't know this location. So it's easy to look up this project.
Okay, but this is close to the Bangalore airport, to put it simplistically, and it's a plotted development.
Yeah.
Somebody said that the airport is far from Bangalore. Yeah, it is far from the main city, but again, Bangalore airport is also a very well developed area, and that's why plotted developments are being sold. In the main city, plotted developments would be completely unaffordable.
And there's no cash flow mismatch and all that. Obviously,
Yeah.
there's enough and more.
I think someone has answered it. It's 45 kilometers from Madiwala, so Madiwala may not be the right place to look it up.
Okay.
Somebody has asked again the minimum investment amount. It's 10 lakhs. Unfortunately, in the future, we want to bring it down lower. Somebody has asked a question on taxation. Will this come under capital gains or normal tax slab? It will come under normal tax slab.
Yeah, and of course the DSRA is being maintained. There's a question on DSRA. There's a 3 month of DSRA. In fact, actually right now the DSRA is much higher because we're sitting on we're sitting on a very significant amount of cash in the bank in this project because a lot of receivables have come in the last 2 months since we invested. So, but by statute, you have to maintain at least 3 months of DSRA, which is the interest cover on the project. So that's obviously being maintained.
Again, a question from Umesh. I think the minimum amount you mentioned is 10 lakhs. Please confirm. Yes, it's 10 lakhs. Plus a few thousand rupees. It's a calculation depending on the day when you buy it. But yes, you should think the amount is about 11 lakhs. Then a very pertinent question from Karan. Thank you for mentioning it. The debenture is being offered at 2% premium. That's correct, as we have mentioned it on our website. And what is the premium for? See, Dalmia has subscribed to these bonds at par. Okay. If these bonds are sold at absolute par, frankly, somebody, Amit and his team who do all the hard work, they get zero compensation. Even Multipie gets zero compensation in all of this. So there is a 2% premium being charged to the investors. And remember, the investors in Dalmia Nisus fund also pay a fee to Dalmia Nisus fund. You guys are not paying any fees to Dalmia Nisus fund because you are not part of the fund. But definitely some compensation needs to be done. There are a lot of efforts going on to this deal. So that 2% premium is that compensation. We have factored this into the yield that we have put on the website. The actual product is 17% plus, but because you are buying it at a 2% premium, the net yield that you will get will be only about 16% because you have paid 2% premium upfront while buying it.
Right. Yeah, I mean, because the larger guys who are actually investing, tens of crores, are getting similar yields actually post the management fee. So one can't offer it to anybody else at a better than the returns being earned by any of us in the deal.
Yeah.
Whether it's
that would be unfair to the investors in the fund because they are paying a management fee. So external investors cannot get it for zero fee.
Yeah, or better terms than that.
And what I have learned, if you pay nothing, probably there's something more to it. So in these products, some fee is payable. I think the right way is to disclose it upfront, which we have done. And thank you to Karan for actually raising it also as part of the Q&A.
Right.
Management fee, then there's a question from Anand that management fee shall be additional to premium on NCD. The answer is no, very much no. You're not part of the fund, so you cannot pay management fee to the fund. So the only cost that you pay is the premium. So the net return would be around 16%. It would not be 15. You're not paying a management fee on top.
Yeah.
There's a question from Kunal. What was the rate offered to the earlier lender which got refinanced?
Yeah.
Amit, do you remember? I think it was around 16.
Yeah, it was about 16.5%.
Yeah.
Was being paid because they, by the way, remember they'd also participated in buying the land. we're not taking any of that risk. It's a completed project. And there was another question: is the project complete? Yes, it is complete. It has received completion certificate from the planning authority, and hence the project is being handed over, and registrations have started, which is why the collections will happen over the next 3 to 6 months as every buyer registers and takes possession.
There's a question from Kunal that generally DESRA is in place for such products to avoid delay in repayments. Is available here as well.
Yes.
But when you buy these products, sometimes, not saying here, the delay can be even more than the DESRA amount. So that's the concern sometimes for rating agencies. But yes, DESRA is available, Kunal, here. There's a question from Karan. How's the sales profile in last few months, which is already covered? Are they finding it difficult, resulting in cash flow mismatch?
Yeah, I've answered that. I mean, there is no.
You have actually, yeah.
Yeah, I have. There's no cash flow. In fact, we're sitting on a significant amount of cash in the bank, by which in fact we can even redeem 1/3 of the paper today.
There's a question from Nisarg. How can we invest directly with NIFCO or from Multipie? You will be buying the instruments legally from NIFCO. Multipie will facilitate that. The process is on our website. You can also reach out to us, email us. We will help you facilitate that. But you will be buying the product from the Dalmia Nisus Fund and NIFCO. There's a question from Karan. If you are comfortable disclosing, how much are the Multipie founders investing? So in this particular project, between the three of us, we have already invested 3 crores. So Amit mentioned that 25 crores is invested by the fund and 5 crores from others. Out of that, it is 3 crores invested by us as founders, and which, by the way, we did it already 2 months ago, much before offering this product on the platform. For us, if the product is not good enough for us, it's not good enough for the platform. That's a simple motto we follow. So we actually have invested in it, got our monthly coupons, and now offering it on the platform. Again, we want you to appreciate that these are higher risk, higher return products than FDs, than a Bajaj Finance FD, which is also available on our platform, by the way. You have the choice. It's a sensible risk return, but that's why we have invested. But you should also keep your eyes and ears open. If you have further questions on this, you should definitely put it on the app. You can mail us, you can put your questions on the app, and we will answer it. Because trust us, for us, the objective is not selling these 2 crores. Frankly, these are immaterial amounts. The objective is that people on Multipie should become more aware, gradually understand these products, and over time, the volume that can be done can be much higher. There's a final question that we want to take from Nilesh Kanawade. Is the capital protected if things go south, like bank deposit up to 5 lakhs? Is this protected by RBI? Amit, you can take that.
No, of course not. I mean, there is no RBI in this. It's we are a SEBI registered fund, and there's a debenture trustee which manages the assets. So obviously we have the ability to step into the project to liquidate the assets. All the monies are anyway directly being collected through us and through Shriram Property. So no, it's not a bank deposit. It is not protected by any insurance provided on bank deposits, and obviously therefore does not carry any bank rates as well.
Question from Vibhor Mishra. Can this be traded on the exchange?
No, it's not rated, it's not listed, and therefore can't be traded on the exchange. And many which ways, as you know, in debt capital markets, even if it was listed, tradability is usually very, very thin. The volumes of even the largest issues of bonds on debt capital markets and listed paper is next to nothing. So, listing also does not solve that problem of tradability. So it's not traded, it's not listed, it's not available on the exchange.
Pankti, maybe you could stop the screen sharing. I want people to look at Amit also a little.
Yeah. Okay, great.
Okay. There's a question from Nirav. So if I subscribe, there is no option to exit before maturity. Amit?
No, so Nirav, the point is that the whole point of this is treat it like you would, let's say, ULIP, where there's a certain maturity date. We don't like it to be liquid. I think the whole point is that we're here to invest for a certain period of time, whether it's 12 months, 18 months, 24 months, and get our investment coupons or interest every month or every quarter and get our principal back in time. In the rarest of rare cases where there has been an exigency and an investor reaches out to us and we're willing to, then we may act as an OTS, or we may act as an over-the-counter sort of a investor where we find somebody to pick up your stock, or we buy it ourselves. But that's not a guarantee. It's something which you should be invested in for the term of the paper. But yes, we have.
Amit, you have been very kind, but we would encourage our users to buy it if they are comfortable holding it to maturity. You should, if you are looking at products that are very liquid, go for some of the things that we discussed: savings accounts, debt mutual funds. We don't want to missell any product. These products can be illiquid, and you should go for them if you are comfortable holding them to maturity.
Yeah.
There's a question on the link for application that's already provided on answered on the chat, so I will not take it. Yeah. There's a question by Kunal. Is this the same NCD that the fund has invested in? Absolutely. It's the same series, the same product, the same NCD that is held by the fund, the same NCD that is invested in by some of us. Okay, we have exceeded our time. So I do want to once again thank Amit for taking out all of his valuable time. First, offering this product on Multipie, because you've done a deal with your hard work. You've agreed to share it on Multipie in smaller tranches for some of our users. Second is sparing your time and sharing some of your knowledge on the sector as well as this product with us. Very big thank you to Amit, and equally a very big thank you to all our users for asking all of these questions. What is less important is that you invest. What is more important is that you ask the questions, ask the right questions, and we together build our journey.
Thank you very much, Sandeep. Thank you so much too. What a pleasure it has been this evening. Thank you.
Thank you.
Stay well, stay safe. Goodbye.
Bye.